Before we do that, real quickly, the entry, stop, and limit. We'll show this on the charts here. You want to enter on the first candle after the breakout is confirmed, and you have the ATR that climbs 10%. So the breakout candle will be the first candle to break out of the Bollinger Bands, and that candle should signify a 10% increase in the ATR. When that happens, I traditionally go in 2 lots. My first target is 100 pips. My second target is 250 pips. The stop is either the middle of the Bollinger Bands plus 45, not an extra 45 pips. It should be actually minus 45. So middle of the Bollinger Bands minus 45, which means that whatever the Bollinger Bands are, we want to subtract another 45 and bring it closer to one of the edges of the Bollinger Band. Or you can also do, your stop can be the previous breakout candle's low minus 15 pips. And so and the number, that little greater than sign, is I take the stop, which is actually greater, whichever one is the greater of the two. Now let's get into some case studies on this one here. And I'm going to bring up a new chart and a new camera coming at you. Let me know when you got the new cam, the new chart. Cool, fantastic, thank you. Okay, so we have here this really unusually tight consolidation period where the Bollinger Bands historically haven't been this tight in not only a year but several years. I actually measured it. It was one of the tightest periods for the Bollinger Bands in over 3 years. It was like something like 4 or 5 years that it had been that tight. So we had just an unusually tight period of Bollinger Bands here, which just by themselves is kind of like a coiling up. It usually suggests that we're going to see an absolutely big move in the pair. Now the real key is when the breakout is happening. Notice how the ATR, if I zoom out, the ATR is falling and hitting historically low levels. This was also the lowest ATR reading right here. This was the lowest ATR reading in over 3 years. There hasn't been an ATR reading that's even come close to that since then. And so looking back at this move now, we can see, look how low it is, just exceptionally low. Now, the first cue, we've had our first logic fulfilled. We've had that really tight Bollinger Bands, unusually tight. Second logic is fulfilled with low, very low ATR. Third logic gets fulfilled. We have a breakout candle that actually pierces and closes outside the Bollinger Band. Now that's that candle right there. What I want to do then is look at the ATR from one day to the next. And so on this day, the little display data box tells us the ATR is about 98 pips. On the previous day, it was about, where are we at? Here we are, this candle right here was about 92 pips. So we had about an 8 or 9 point decline, which is about 10%. To me, that would totally qualify. Now from the absolute lows, look at where the absolute low was, 87. So we're now at about a 12 pip gain from the absolute lows. That to me suggests that a huge amount of capital is coming into this pair to really propel it outside of this range here. That is what I'm looking for there. So when that happens, I'm in at the close of this candle or the open of the next one. My stop is either the middle of the Bollinger Band plus 45 or minus 45 pips, so it's right about here, or I take the previous low and subtract 15. Either way, I'm protected in both of these cases. The next day, it gains a little bit, comes back up, and then look at that. It just continues on for, that was like, I think, 6 weeks. It was a total continuation for about a 6-week move. Even a 4-week move, I mean, look at all these blue candles. You only had 1, 2, 3, 4 of those red candles. So these types of positions tend to hold for a long period of time and suggest a massive upside breakout. Another thing you can do is instead of, once you've taken your profit target on your 100 pips, on the second lot, you can use a 20 EMA as a trail or a 10 EMA. I would choose a 20 EMA would probably be the better of the two. You can use a 20 EMA as a trail, and that would keep you in the position till about here. So it'll keep you in the position a little bit longer if you don't have the patience. Now granted, this is on a daily chart, so you're going to have patience, which is something most currency traders lack as a whole. And so we, like our coffee, we like to ring the register. We like to see that cash in the shorter term instead of the longer term. Very few speculators and retail traders actually hold positions longer than a week or two. So that's why I suggested the 250 pip profit target. Let me show you an example of another one. Let me give you another chart here of how this works again and again and again. Now granted, this is on a daily chart. I have an intraday version of this, but that one costs you. I can't just give that one away. That one is very active. All right, so it's minus 45. And what I mean by that is, when I say the minus 45 is, whatever the Bollinger Band is, whatever the middle of it is, I want to subtract 45 from the middle. So in this case, the middle of the Bollinger Band is about 35.80. Therefore, I want to be at 36.25-ish. Now, it's the greater of the two. So it's either that, the minus 45 from the middle, or it's the breakout candle's low, minus 15. Actually, it should be plus 15 pips on that point. So my apologies on that. I have my addition and subtraction reversed, which is like kindergarten all over again. So I usually take the greater of the two. It really just depends on how tight the Bollinger Bands were and where the breakout candle opened. But let's take a look at this here. So we have the qualifications for the logic. We have unusually tight Bollinger Bands and just unreasonably tight. Then we have a falling ATR. ATR at historically low levels has only been this low one other time in the last 3 years. And so that to me suggests we're in a huge dropping off of volume and volatility. And what most often precedes huge drop-offs in volume volatilities is a resurgence of that liquidity coming in. When the liquidity comes back in, because there's no volume in there, they get to move the pair in one direction or another very easily. So where was the ATR at its low reading? At its lowest point, it was 0.0147, 147 pips basically, daily range for the pound Aussie. On the breakout candle, which is this one right here, which is 316, let me get that candle back, or that line back up. Here we have our breakout candle. Let's look at the ATR reading now on this day. The ATR is now 161 pips. So we went from 147 on the absolute low to 161. It's about a 14 pip gain, which comes out to about 10%. And so there we are again. We have the 10% increase off the absolute low in ATR. We have the breakout candle, which is now closed outside the Bollinger Band. First time it's done that in 2 months. That to me suggests huge breakout, and the ATR is climbing at a sharp, sharp angle. So that means that most likely a lot of money has just come into this pair, and it's come in at a point where there was no money involved. That means they're pretty much going to have free reign to push this pair around for a huge, huge move. And so therefore, we're in at the open, the close of this candle or the open of this one here. Stop is in the middle of the Bollinger Band, plus 45, or the previous low of the breakout candle, adding on 15. And so look what happens here. You would have had your profit target very, very quickly on the first one and the second one. You would have hit both in the same day. Or if you had trailed, let's take a look if you had trailed with the moving average. And I prefer 20 EMA on this one here. Moving forward on the chart, it would have kept you until about 142, and you would have gotten in at about 37.98.38. So it's about 400 pips. And so you can see how powerful this is for catching massive, massive breakouts. Now again, this is on daily charts, so you should expect to see large moves. On the intraday level, if you were to grab 80, 100 pips, 150 pips, that would be exceptional there. So that's what I'd be looking for. Now I have one more example of this. This was one of the big trades that I was pushing when I was working for the hedge fund. I had massive, massive debates about this one here with my the CEO and the president of the hedge fund there. And luckily I won on this debate. All right, so here we go. We had a very, very tight period of consolidation in 2006. It was really just kind of a coil. The ranges, was about 900, 1,000 pips, and then it got to about 500 pips. And then we got stuck between this really tight Bollinger Band here, which is between the 225 and the 228. It was about a 300 pip range. Oh, not seeing the chart? Thank you for reminding me about that. I appreciate that. My apologies. You should have it in a matter of seconds. Let me know if you got this one. Great, thank you. So the range got really tight. It got to 300 pips, and then at one point it actually got to like 280 pips there. It was very tight for pound Swiss on such a long time period. You're talking about 4 months there to be caught within the 300 pip range. And so then we have, and if you also look, so we have the tight Bollinger Bands. Logic number 1 is fulfilled. Logic number 2, unusually low ATR levels. Again, this is 3 years. If I mark this low right here, that's the lowest it's been in 3 years. So it qualifies as an unusually low period of volume and volatility. This was actually one trade. There's this one commodity trader who in the 70s, they used to call him the Cotton King. And so I actually got to meet this guy. The guy had 12 monitors in his house, and he lived in Texas, and he was just an absolute character. He's in his 70s now, made a ton of money on origins and cotton and all kinds of things. Anyways, he was asking me for, he goes, look, you know, he's like, I need a really good trade recommendation. He's like, trade recommendations you guys have been giving out, this is FXCM or just junk. He's like, I'm looking for something unique. And I said, this is what I got for you here. And I showed him this one, and his eyes totally lit up, and he said, wow, now that could be something huge. And that's what interested him. He was only looking for huge moves at this point, you know, ones that are high probability, huge profit targets. So look what we have. Historically low volumes of ATR. And then we have a logic that comes in that fills this here. We have a breakout candle. This is an exceptionally big candle. This is the biggest one-day candle in over the last 3 months here. We also have a sharp rise off the absolute low. Now here's the breakout candle. Let's take a look at the ATR had a low print of 91 pips on a daily range. That is unbelievably tight for a pound Swiss on a day-to-day basis. And then on this candle, it goes up to 100, it's about 100.1 pips. So we have a 10% increase here, and the ATR bounces up very sharply. Great sign that this pair is going to break out. And it does, and same thing. We are in on the open of the next candle. Stop is the middle, plus another 45, or the previous low of the breakout candle, adding on 15 pips. Never gets touched. Profit target of 100 pips was reached within the next candle, and then the 251 was reached about another week and a half later. So again, you'll have to be patient on this one here. You're going to have to be patient because it is daily charts. If you want the intraday version of this one, I have a much more advanced intraday version of this one. Then we'll talk after the show here. But so that's pretty much it in terms of how the Bollinger Bands work, and then how you can use them with ATR to determine when we're going to have a massive breakout. And so I'd like to go over the last point in the PowerPoint, which is a review of all the things. We're going to be wrapping it up here soon. And I'll give you a... There we go. You should see a PowerPoint coming on there. Okay, so to review all this, Bollinger Bands are fantastic, absolutely fantastic for determining volume and volatility. As Stevie J cued in, they're the option trader's Bible, absolutely. Especially in the Forex markets, since we do not have any sort of access to order flow or volume levels, we have to use indicators to give us as much information as possible. When we get an idea as to volume and volatility, then we can really tell whether this is going to be a sustainable move or whether it's going to be something that's going to be reversal shortly thereafter. And so volume and volatility levels can often determine that. There were huge cues for that in the Dow after the Dow sold off to about the 12,000 mark. When it bounced off the 12,000 mark, volume was decreasing, suggesting that the Dow was not going to have massive upside gains, and that rallies, you could sell rallies for moves continually back down. This was a huge clue in the Dow, and is also clues in the currency markets as well. So I use Bollinger Bands in huge ways to catch reversals or fades that often people will not take because they're too busy looking at the trend itself and not really realizing, hey, there are some huge signs and logic in play that suggest that this pair is going to reverse or fade from here. And so that's what I use them for. When you combine them with the ATR, they're absolutely an ideal combination for catching large breakouts. And so that's pretty much it